Well, good morning. This is Rich, and welcome to the afterMATH webinar. This is the first one of these webinars that we're going to hold, and we will continue to do these the day after the USDA crop report each month. Yesterday we had USDA's March supply demand report, and then the idea is that the next morning we'll visit and we'll talk about the numbers, we'll talk about the repercussions in the marketplace, and then we'll talk about the marketing ideas and how to utilize your crop insurance policy to do some things in the marketing side. So that's kind of the quick overview, and we'll go ahead and get started. And one of the things, I did find this quote on Twitter recently, and I thought it pretty well describes a lot of our markets, especially right now, that marketing is easier once you accept that markets are often irrational. And certainly no one can disagree that today's markets are very irrational. We see a lot of very violent trade, to say the least, both directions. And but one of the things that I continue to stress is that if we can maybe not focus so much on the nearby and what the market's doing that day, but focus more on the big picture of why markets are going to do what they're going to do, why we think markets can change for the year, and then utilizing all of the tools that we've got to be able to take advantage or at least be able to protect ourselves against certain things happening in the market. So that's kind of my mission, and there's no better time to talk about irrational markets than right now. But so my focus for 2020 is, first off, selecting the right crop insurance coverage for the year. This might just be multi-peril insurance, might be hail and wind, might be some other products, but whatever I need to do to be able to protect, make sure that I'm going to have a crop to sell at the end of the year. Choosing the right government program to provide disaster support. And I look at these government programs like PLC and ARC really as disaster programs. At the end of the day, if prices go below the PLC prices, I would consider that a disaster for agriculture. So we want to make sure that we're protected in case that happens. Utilizing marketing tools, we'll talk about some of that this morning, not just hedging, but also we'll talk about using some options and some different types of strategies. There's one in particular that I really like for this year, given the fact that we're expecting more acres. And then the last thing I got on here is all of the above. And we all know that if you take a test, and usually if that's one of the answers, that's usually the right one, and it is certainly here for this year as well. So where are we now? Well, started the year thinking that the big story was going to be this trade war, and the fact that we got this phase one trade deal signed a couple of months ago. And if we get this thing to move to fruition, and if we get the benefits of all of it, it could be just a phenomenal thing for U.S. agriculture. You can see the chart shows that in 2020, China has agreed that it's intending to buy an additional $12.5 billion in ag products from the United States than what it bought back in 2017. Next year, they're expected to buy $19.5 billion more than what they bought back in 2017. So if this thing does happen, and it does get carried out, it could be a tremendous thing for the United States agriculture sector. However, we all know over the last few weeks there's a lot of challenges. First of all, this coronavirus outbreak started in China. It shut down the Chinese economy, and it's shut down shipping, it's shut down manufacturing over there, and it's had a lot of impact now across the world. We've seen it spread through Europe. We've seen it come into North America. This is the latest I pulled off of Fox Business yesterday, but 650 plus cases in the United States so far, and likely continue to grow. And more maybe having an impact on us, it's going to impact trade. It's going to impact what people do, travel, meetings, things like that. So certainly it's at the forefront right now of our markets. And you can see that we're trading a lot of fear in the marketplace right now. That shows up in the stock market. We've had the Dow and the S&P down more than 50% from where they started back at the beginning of 2019. So it's certainly been a violent reaction. It's forced a lot of money to move away from investments and move into bonds and interest rate bearing accounts. And so you can see the impact on the 10-year Treasury, the 30-year Treasury moving to record lows right now. So interest rate paid on any of these investments the lowest they've ever been. And so it's a good time if you're looking to buy land or if you're looking to refinance a house, but it's not necessarily a good time for investors. The impacts extend into the commodity markets. We've seen crude oil trade sharply lower, first of all, because of the coronavirus impact, because of the lack of travel, lack of trade, perception around the world. But then you throw in this weekend price war between the Saudis and the Russians, and the U.S. kind of caught in the middle of that as well. But certainly the Saudis saying that we're just going to continue to produce, push the oil market to new lows, back to the lows from early 2016. The commodity index, which crude oil tends to be one of the major drivers of, commodity index at the beginning of the year, we're trading down to the lowest it's been. And yesterday we saw a little bit of a bump due to the rebound in crude and some of the commodities, but commodities as a class continue to be under pressure as well. And the dollar. The dollar had been on a 2-year rally, mainly because of other currencies falling, but here lately, even the dollar has come to some pressure as a lot of cash is just getting me out of whatever. But unfortunately for us, the strong dollar has had a huge impact on what we're able to sell. It's not cheaper than the real right now. The Brazilian real currency is even lower than the dollar. Even though the dollar's falling, the real's falling faster. And so that's made Brazilian crops cheaper relative to U.S. crops in the world market. Continues to really hinder our ability to ship, especially soybeans and especially corn. And we'll look at that here in a few minutes. So going back to where we just started talking about what's going on with China. China's what we're really counting on in the ag markets to really make a difference for us. And you can see that 2020 exports to China have improved, but still nowhere close to where we were, less than half of what we were back in 2017 at this time. And so we're really going to have to pick up the pace, even just to get back to 2017, let alone to meet that $12.5 billion that was forecasted here under this new Phase 1 trade deal. So a lot of ground to make up, and right now the market's just certainly focusing on other things other than trade. So, glance back at yesterday. Yesterday's USDA report was really a non-event. We did not see any changes at all to the wheat balance sheet. USDA is still forecasting ending stocks below 1 billion bushels for the first time in 4 years. Average farm price forecasted at $4.55. That was also unchanged. Soybeans forecasted unchanged as well, ending stocks at 425 million bushels. USDA did lower its average farm price to $8.70. That was down a nickel, and that would potentially impact a PLC or an ARC payment. We'll talk about that after a while. The big story in beans, still in the balance sheet, is exports. Exports are forecasted a little over 1.8 billion, but we're still down 300 million from where we were just 2 years ago. That's going to have to change quickly if we're going to see any kind of a bounce in the bean market. Cotton, USDA did make a change. They lowered the yield for the 4th straight month in cotton, lowered production 300,000 bales, lowered ending stocks 300,000 bales to 5.1 million bales. And that's somewhat of a very positive thing for cotton, because if you remember back in like November, we were looking at 7 million bales of cotton. Now we're back down to a pretty manageable level, and if exports continue to be decent, maybe you see that number possibly fall below 5 million bales. Average farm price, USDA did drop that to 60 cents. That was down 2 cents from last month. And then lastly in corn, no changes to the balance sheet numbers. USDA still forecasting a big drop in exports this year, and again, that's all driven by this Brazilian currency situation relative to the U.S. dollar. Ending stocks forecasted at a comfortable close to 1.9 billion bushels. That number may eventually slide down. I think that a lot of us think the production number's probably still a little high. USDA still may come in at some point and adjust to the crops that are left in the field in the upper Midwest. Still, we're going to be looking at an ample stock number. Average farm price, USDA dropped to the nickel to $3.80. So again, that would impact potential ARC and PLC payments at the end of the year. Now, the changes they did make, the big changes were in the world numbers, and especially in South America. USDA bumped the Brazilian production 1 million metric tons, took Argentina up 1 million metric tons. So combined, a record 180 million metric tons of soybeans down there. And it's really interesting. Look at what the Brazilian crop was this year relative to the U.S. crop. For 30 million tons higher than what we produced this past year. Now, that last year, back in 2018, of course, that was a different scenario. The U.S. still outproduced Brazil, but that seems to be changing. So we'll follow that as we go forward. The Big Four, producing almost 295 million metric tons of beans. That is down about 14 million tons from last year. So if there's one net positive is that the drop in U.S. production this year did take world stocks down. However, because of the drop in demand from China right now, it's going to offset that drop. So, and the fact we've got Brazilian harvest picking up pace as we go forward. So what's ahead? Well, this is the story I thought would be the biggest one of the year, and that's crops. What are we going to plant this year? And if you look back to a year ago, we were down about 16 million acres, total planted acres of the major crops in the United States, to all the prevented plant last year. Most of that is expected to get planted this year. The Ag Outlook Forum, which met about a month ago, forecasted corn acres at 94 million. That's up 4.3 million from last year. Soybean acres expected to jump about 9 million. Wheat acres steady. Cotton acres expected to slide a little. Sorghum acres expected to be higher. Rice acres expected to jump this year. Total planted acres of the 8 major crops expected to be 250.7 million. That's up 12.7 million acres from last year. It is still 3 million below where we had been the prior year, and I think that's probably accurate. I think we're still going to have some bottom ground that doesn't get planted this year. I think we're going to have some of that upper Midwest ground possibly won't get planted this year. So it wouldn't be a shock to see all of those acres not come back into production. Still, adding 12.7 million acres is a huge, huge number, and it depends on the crop makeup of those extra acres. Now, 3 weeks ago, Farm Futures Magazine put out its updated survey. We're estimating corn acres at a whopping 96.6 million acres this year. Huge number there. Bean acres expected to still be up 80.6 million. That's only up about 4.5 million. Winter wheat acres steady. Sorghum acres up. Rice acres up. Cotton acres down. So we'll see where it all lands come spring. Now, we know we're entering into a spring where things are fairly wet still through much of the country. And you can see over the last 12 months that still one of the wettest years on record, and it was the wettest in 4 of the states in the upper Midwest. Looking at soil moisture right now, this is a pretty cool map from NASA, but it shows the groundwater. It says drought indicator, but we really don't have a whole lot of that showing up right now, especially in the areas where most of the listeners are at. But we're still looking at a fairly saturated situation here as we move into the middle of March. And the forecast over the next 5 days looks fairly wet through the Mid-South. Much of the area that's trying to get started with some field work. I know we've got some work started in southern Texas, in the southeast as well. I know we saw some pictures over the weekend of people trying to collect beans even in the Midwest, people doing some anhydrous work. A lot of that looks like it's on hold right now. The forecast over the next 2 weeks doesn't look any better. It looks wet through much of the country, both 6 to 10 and 8 to 14 day outlooks. The change in the soil moisture, if we can add any, it appears that much of the country is expected to get wetter over the next 2 weeks with compared to normal. The 30-day outlook that came out at the end of February did show much of this Ohio Valley and Mid-South expected to be wet over the month of March. And then as we look at the extended forecast for March, April, May, still continues to show much of the country with above normal precipitation. So a lot is yet to be determined as far as acres go, as far as plantings go. But it doesn't appear that we're going to be off to a very early start again this year. So even though those are some of the forecasted numbers from the Ag Outlook Forum and from Farm Futures and even Informa and some others have put out their acreage numbers, we'll be kind of curious to see what the weather does. That'll certainly have a big impact. By the way, March 31st, big day coming up in 3 weeks. That's when we get the planting intentions report from USDA. That'll be their first official survey of farmers' intentions for acres this year. And, of course, those intentions can change, but it'll be the first official set of numbers that we get from the government for the 2020 crop year. So digging into some of the crops, I'll start out looking at the soybean market. The big story right now is exports or lack thereof. So far this year, we did see China as a buyer of some beans, and most of that happened ahead of the trade deal getting signed. Since then, this week, I've actually seen China back in the market for the first time in about 6 or 7 weeks. China's bought beans 3 straight days this week. So maybe it's going to start to pick up a little bit, but you can see that we got a lot of ground to make up just to get back where we had been in the previous years before the trade war had kicked in. Here's another snapshot. Now, at first, this one was just total exports out of the United States, but it really does, this one here, show how China makes up such a big part of that. That China, the black line here showing what they bought so far this year. It is better than a year ago, but they're still way below where they had been the previous 4 years. Now, the other thing I would point out here is look at how these curves really start to flatten out this time of year. And that's because we get into South American harvest, and once that happens, typically you see a lot of this Chinese demand move to South America. And that's what's expected to happen this year with that big crop. So, and with the currency situation. So we're really going to need to see China be a buyer right now of a lot of beans if it's going to make a dent in the big picture. And I guess this shows that. This is the typical 10-year average of what happens in South America versus U.S. Really, the U.S. kind of tends to rule from November till March. And then after that, Brazil becomes the big player in the game. So, again, our time is short if we're going to see much of a dent in some of these stock numbers. If not, it maybe it'll fall before we see us get back in to the market with China. Funds. For those of you that haven't listened to me talk before, one of the things that we really focus on is the managed money position in our markets, or the hedge fund position. Typically, these hedge funds, whatever they do in the market, tends to really move our markets. And we really have seen that in the bean market this year. And you can see the black line, especially since the beginning of September. The funds have been in and out of the bean market a lot. A lot of this has been driven by, will we get a trade deal done? Won't we get a deal done? Then the coronavirus kicking in, the lack of Chinese demand. But certainly the speculative money has really driven what's happened. And if you go even back further, go back to the red line last spring, shows when these funds were holding a record short position in soybeans. Then we had the weather market come into play, and funds became huge buyers. And after that, they've been back and forth in the market. And it really shows that if you focus just on from spring of 2019, when we put in our low down around 780, and from then on, we've had a very erratic trade, and this has all been driven by what the funds have been doing in these markets. As we sit today, we're sitting down near the lows, even though we're a little off of the weekly low, but still near the lows of the last few months. If I've got old beans to sell, I'm probably looking at some of these moving average lines on the chart, like up around the 890 level, where the 100-day moving average is at 894, probably a decent target if I need to be selling some old beans. The other thing I like to point out on a lot of my charts, and we'll do that going forward, is this relative strength index at the bottom. The green line, it's a pretty good indicator of an overbought, oversold market. And this really stands out more when we look at the daily charts. But as it sits today, the RSI at 42 and the stochastics both would indicate the bean market's probably pushing into an oversold situation right now. Looking ahead, a lot of possibilities for this coming year. In soybeans. Informa came out last month at 86.5 million acres of beans. Firm Futures, on the other hand, is only forecasting 80.6 million acres of beans. And it makes a huge difference when you look at the bottom line. When you go down to ending stocks, if we had 10 million acres of beans, we are most definitely looking at an increase in ending stocks this year if we had any kind of production. If we only had 4 million acres, we could make a case that if demand is strong, the stocks might actually drop this year. So I think there's still a lot to be written in the bean story for this coming year. Part of this really relies on exports, and I'm forecasting exports at 2 billion bushels. What if it doesn't happen? What if China doesn't buy additional beans? What if we only end up with 1/8? You raise each of these numbers at the bottom by 200 million bushels. So while acres are certainly going to be part of the equation, this export demand number is going to be critical as well. And how much of this extra bean load do we eat away at this year? So, looking at November futures, of course, I don't want to be a seller today. The RSI is at 31, very oversold market. Stochastics showing that as well. So I'm going to wait for some sort of a rebound. I want to be patient. The other thing I point out here when I talk about the RSI down at 30, which is this blue line, is typically a buy signal. Means the market's oversold. When the RSI gets to 70, the red dotted line, usually that's a buy or a sell signal, means the market's overbought. And I pointed out here each of the times that the RSI hit or nearly touched that red line here over the last few months. As it sits today, I'm willing to be patient. My target going back to last fall has been 950 beans, and we've been above it, below it, above it, below it. I think if I were to pick a target today, probably looking at this, the convergence of the 200 and the 100-day moving averages, both of these lines sitting at about 945 right now. So if I've got to pick a spot to start selling beans, I'm probably looking at 940, which is about 50 cents above where we're at today. And I think given the fact that we're expecting more acres this year, I want to be a pretty aggressive hedger if we get back up to 9.5. By the way, the other thing I did mark on here, the crop insurance price was set at 917 in the northern states. That's this green line right here. So if we get above that level, to get up around that 940 level, I want to be pretty aggressive. The other thing I want to do is maybe bushel for bushel. I like the idea of the put and call strategy, a min-max, a floor and a ceiling, whatever you want to call it. But back in January the 2nd, this is something I had written about then, was buying a $9.68 put, 60-cent put, selling a 1040 call. And at that point, you could have done that spread at 9 cents a bushel. So after the cost of the trade, I would have had a floor at 951, a ceiling at 1031. I would have felt pretty good going into the field this spring with a floor at 950, still have 80 cents potential upside for the market. Now, can't do that today. But if we get back around that 940 level, this is something I'm going to be writing about. And we may be looking at like a 920 floor and a $10 ceiling or something like that. But I think given the prospect for many more acres get planted this spring and not knowing what's going to happen with China, I think it makes a lot of sense to me not only to be a hedger to lock some in, but also to do something like this where I can put a floor under some beans, still allow myself some upside if the market trends higher. The corn market, kind of like beans, we're really being hurt by the strong U.S. dollar this year and the lack of competition with South America. And it's really showing up here. Over the last 7 years, we're struggling. We're at the lowest level in export sales that we've been in that period of time, going back to the drought year of 2012. And so something needs to change for us. And unfortunately, if you're a fund trader, why do you want to be long corn right now when the story's been this negative? And so without the export market, you can see that the funds over the last 6 months continue to be short the corn market. Now, the other thing I would point out for the optimists is look at the history of the last 6 years. And you've seen every year that there was some point that these hedge funds went long the corn market. Most of the time it was in this June-July period or May-June-July window. Usually it was an acreage issue or possibly a growing season issue. So I'm not willing to panic just yet, but certainly be aware that when the funds get back on the long side of the market, when and if, that gives us our best marketing opportunities. We saw it last year in particular. If you go back to last spring in the month of April, these hedge funds were holding a record short position in the corn market. At that point, we had trouble getting the crop in the ground. They got scared. They started buying a lot of corn, and they bought 500,000 contracts of corn in about an 8-week window, and it rallied corn $1 a bushel. Then, once the crop got established and the ratings started looking good, the funds turned sellers, and they've been on the short side ever since. And this is what it looks like in the market. You go back to 2019, this is the fund rally that was driven back last May and June, rallied corn $1.30, and they turned sellers, and since then they've been on the short side of the market. Markets have really tightened into a fairly tight trading range. So if I have old crop corn to sell, I'm probably looking at 390 or above. On the nearby contract, I still, 390 to 395 has kind of been the winter high, and I still think that's not a bad place to cash out. If you're really bullish and you think that USDA is going to lower the production number at some point, that's probably going to be late spring or summer. And so I don't know that I want to risk waiting that long. I do want to take advantage of basis opportunities when we can. And one way to do it, maybe is you sell the corn, maybe you buy a call option. Or maybe you sell the corn now, and if we get a setback, then you buy the call. But there's different ways to go about it. But I certainly think one of the big story this year is going to be acres. And so when you look at the balance sheet, Informa is projecting 93.4 million acres. Farm Futures is all the way up to 96.6. And in either one of those instances, I'm showing stocks are going to rise this year, possibly to a 30-year high above 3 billion bushels if we plant 96+ million acres of corn. So I definitely want to be a seller. In both of these instances, I'm projecting prices going down, depending on how many acres and how big the crop is. You could certainly see a lower price this year. So I want to get out in front of this market if we get a chance to make some sales. $4 has been my target for a few months. And I think if you look back over the last 6 years in the corn market, if I've had a chance to sell $4 corn, it's been a pretty good sale. And so I want to take advantage of it if we get the chance. Maybe we don't quite get there before I get started now, given the fact that the 100-day moving average is down to 396. Probably going to eye that 395 area as a place to start hedging some corn. If we get above 4, I want to be a little more active as well. Today, the RSI is at 41, so really not a time I want to jump in the market. Similar to soybeans, the strategy I really like in the corn market this year is this buying a put and selling a call. And if you go back, rewind back to January 2nd when we had the market peak out, we could have bought a $3.80 put option, sold a $4.50 call. So have a ceiling at 4.5, which I think everybody would be okay with. Have a floor at 380. The net cost was 0 cents a bushel that day. And while I don't know that we can get that done again if we get back to $4 or even $3.95, I still want to look at some of those option type trades. Maybe it's a 370 and a 440 floor at a ceiling, something like that. But if I get a chance to put a floor into this market, keep in mind, you look back at some of the monthly charts on corn over the last 7-8 years. We've taken corn to 3.25. We've taken corn to 310 in the fall at lows. So it can happen. And so I definitely want to put a floor into this market. If I can allow myself 50, 60, 70 cents upside at the same time, I think that makes sense going to the field this spring. And the next time we get this bump in the market, we're going to be ready to try to jump on it. Wheat market. Wheat's actually been the market with some positive things going on, and a lot of that's been driven by acres. Winter wheat seedings this year were the lowest since 1909. It's pretty incredible how we've seen such an acreage mix change here in the United States over the last really 15 to 20 years. The other big story has been Australia. Australia's had 2 drought years in a row, and that has all of a sudden brought some demand back to the United States, demand that we hadn't seen in a long, long time. So that's been a big positive for the market. And you look at the export sales, sales are the highest this year they've been in the last 6 years. And so that's been a nice positive, and it's brought a lot of investment money back into the U.S. wheat market. You can see how we stand up relative to the other sellers. Russia still holding the top spot. Europe has seen a big jump this year, certainly in response to the Australian crop. But the U.S. continues to climb as well. And so that's been a nice little positive that we've seen a demand-driven market in wheat. And you've seen what the funds have done. You look at the black line since September, they've been active buyers in the soft red winter wheat market. And even today, even after the sell-off of the last 30 days, they're still holding the biggest long position they've had in 8 years. And so I think that's pretty incredible that we've had a demand-driven market in wheat. We just haven't seen that happen in a long, long time. It shows up here in the chart. You look back to last September when the funds started buying, they rallied Chicago wheat $1.50 in the nearby contract. It's an incredible run. And we have seen the market sell off about 50% of that. I do think as long as the 50 and the 100-day moving average, the gold and the purple lines, as long as we can hold support there and maybe start to turn the indicators higher, the RSI kind of trying to turn higher at 48, stochastics maybe trying to bottom out as well, then maybe we can start to see a little upside in this wheat market. Looking ahead, Informa saying acres maybe slightly higher, a couple others saying maybe slightly lower. But even with bigger acreage number this year, I'm expecting that stocks are going to drop in the year ahead, maybe down to 850 million bushels. And as long as export demand continues where it's at, I think we could be looking at a better price here as we move forward. And so I'm pretty optimistic to the wheat market. And when you look at July Chicago wheat, we're still, we have taken off some of the rally, but we're still holding above $5. The target here is around the 540 to 550 area. 542 is the 100-day moving average. 552 is the 50-day moving average. And also we had our peak back in October at 545 3/4. So I think if you get back up into that area, 20, 25 cents, I think it's a good place to start rewarding the market. And also keep in mind the indicators at the bottom, the RSI is at 35 today, but if we rally 25 cents or so, you're probably going to be in the upper end of this range. So I think that's a good place to be setting some targets here for this year's crop. Kansas City wheat, very similar, although the chart looks a little different. But I think, again, if we get up around the 100-day at 470, the 50-day at 486, probably be some targets to look at, being able to hedge some of that crop as well. And Minneapolis wheat, I would look at the 100 and the 50-day moving averages around 560 is a good target there, and that's about 22 cents above last night's close. So, and again, all these markets, I don't want to be a seller today. If we're able to get much of a bounce, I certainly think it would be a good opportunity to start locking some in. Reward the market when we get a move to the upside. The cotton market. Cotton's had some good news, and it's really been driven by export demand. We have quietly seen China back in the market. You can see really since about the middle of January on, other than a couple of weeks here in February, we've seen some pretty good demand numbers out of China and U.S. cotton. And so that's helped to support the fund line and make these funds more active in the market. And we've really seen that. When you look at what they've done since back at the lows in early August, it's been a huge buying run. They've gone from about 50,000 contracts short now to long about 35,000 contracts, and it's made a difference in the market. You can see here since we took the lows in August, we rallied over a dime a bushel in the cotton market. Now, as of the last week or so, certainly we've had some selling. Or the last couple of weeks, and that's all, again, been driven by the coronavirus selling and the fact that China's not been in the market lately. But I still remain somewhat optimistic because of demand, and I remain optimistic because of acres this coming year. And if we're thinking that cotton acres are probably going to slide over into feed grains and other, maybe soybeans, and if acres end up down, if I use Informa's 13 million number and use a decent demand, I think stocks could drop in the year ahead. And so I'm a little optimistic towards the cotton price here as we move forward. And keep in mind, I'm even using a very good yield at 950 pounds, 850 pounds, which kind of matches where we were a couple of years ago. So we'll see. I think if China steps up to the plate, maybe you even see some of these stock numbers drop even a little further. So I want to be patient today selling cotton. I don't want to be a seller right now. The RSI is at 29. Stochastics both show the market oversold. But if we get back up into the 68, 70 cent area, I think it makes sense to be rewarding the market again. If that happened, I certainly think you'd see the relative strength index back up, pushing that 70 number. So we got the 100 and 50-day moving averages in the 68. That would be a good target for me. And I like the similar strategy I talked about with corn and soybeans with cotton. I like the idea of putting the floor into the market and taking a ceiling. Back on the 2nd of January, here's what we could have done. We can't do that today, and even if we get to 68 cents, we won't be able to do this. But if I get a chance to maybe put a 67, 66 cent floor, taking a 73 cent ceiling up where the highs had been, if I can do that for little to no money, I think that's a decent strategy to consider here in cotton this year. Give yourself a little room to breathe. If the market trades higher, but don't necessarily lock yourself in. So I like that strategy, and we'll be watching that here in the weeks ahead. The livestock markets, of course, have been dominated by a lot of the talk with pork and the pig numbers in China. And you can see here this chart shows that pig numbers expected to go to a 27-year low this year. And so since dead pigs don't eat meal and don't eat soybeans, then it's going to be difficult for us to see exports in those products. But I'm still fairly friendly to the pork market based on the fact that Chinese numbers are down and based on the fact that their pig prices have been really screaming higher over the last 12 months. And so they're trying to rebuild the herd over there. It's just going to take some time to get that done. So in the meantime, I think that they should still continue to be in the pork market. And you've seen that happen over the last 3 quarters. Pork imports into China have really jumped. Now, we didn't get much of that. Most of that new demand went to Europe. This was prior to us getting the trade deal signed. When the coronavirus gets kind of sorted out, I really think some of this demand is going to come back to the United States. And to me, that would be the easiest way for China to spend money rather than trying to do it on grains would be to buy the pork. And so I'm still bullish here. I still think that there's some upside here to this hog market. And we've already seen some of that. And keep in mind, most of this is prior to the coronavirus outbreak. But we did see China and the U.S. or the exports as well as exports to China both really jumped here in the winter months leading up to the trade deals. So I still think that there's some buying to take place, and I'm still optimistic here in the hog market. Looking at the chart, we've been all over the place, of course, but over the last few months, we've kind of pushed back up a little bit since the trade deal's been done. If you really, like I said before, if we get this coronavirus deal fixed, if we, start seeing the numbers really slip, if China comes back in the market, I think we could certainly challenge this winter's highs, and it wouldn't be a shock to see us trade up into the mid-70s or so in the nearby hog market. So again, I remain fairly optimistic there, given what I think should be good demand out of China. The beef numbers are kind of following along. We're one of the better years we've had in beef exports over the last 10 years. Poultry numbers not as great. We've seen a lot of poultry moving out of Europe this year, but certainly the beef numbers I think could continue to follow pork. And right now, not the time I want to be selling cattle if I don't have to. You look at the RSI on the weekly chart at 32. And on the feeder cattle at 35, both of these markets appearing to be oversold right now. So I think a good target in live cattle nearby would be around the 113 to 114 level. That's the 50 and the 100-day moving average, and that's about $8 to $9 above where we're at today. So in the weeks ahead, to me, these are the major points. Coronavirus is still the major factor in the market. Fear and or the impact of the virus, certainly, the impact has really kind of taken over. We've seen events closed or shut down or not taking place. We've seen travel and trade really impacted. But a lot of this is emotion right now, and so we'll see going forward if that eventually starts to die down. And then following that will be actual Chinese purchases. Does China step up to the plate and buy some beans, buy pork? What do they buy? Cotton. Those are what we really need to see, especially in the soybean market right now. South American weather, I don't know that it's as much a factor. Maybe going forward it will be with corn and planting the second corn crop, but I do think that the currency market is a big, big deal. What happens to the Brazilian real versus the U.S. dollar, that's going to be a huge story as we go forward. And then lastly, U.S. acres. I think this is still, as you go into next fall, going to be the major story. How many acres got planted to which crops, and what did it do to production? And did we overproduce? I guess that's going to be the big question here this year. Crop insurance, we did set all of our prices now. We have our sales closing deadline on February the 29th in the southern states. We've still got another 5 days up until March 16th in the northern states. Prices generally were a little bit below last year. So our guarantees and our premium prices both should be slightly below where they were a year ago. But a couple of points I wanted to make out is where prices are today relative to where the crop insurance prices have already been set. And this is a slide that I showed to folks down at the Commodity Classic about 2 weeks ago when talking about crop insurance and working with crop insurance with marketing. And I pointed out that revenue insurance policies really have 3 built-in options. And the one we're talking about right now is the first one. That's the price put option that's built into a policy. And basically that means if price goes down far enough, revenue insurance is going to trigger a loss. You're going to have a loss in revenue, and you're going to get paid for that. So that's how your crop insurance policy really is working right now to provide some price support. Of course, we know that your policy also has a put option on yield. If the yield falls below a certain level, you're going to get paid. And your policy also has a call option. If we have a higher fall price, then your guarantee from your policy is going to get recalculated using that higher price that was set in the fall. So you get the opportunity to buy this policy with all of those options really at a subsidized level. But the government's picking up anywhere from 40% to 65% of the cost of these policies. So that's a lot better deal than it is going to the Board of Trade and trying to buy put options and such there. But showing this graphically what the impact is of your put option in your policy, if I look at a revenue policy in the northern states, that base price was set at $3.88. 85% of that is down at $3.30. So in other words, if I have an 85% RP policy, and let's assume, because it's early, but let's assume that we end up raising an average crop, have an average yield. My yield comes in right at where my APH is. Price would have to fall. If the price falls below $3.30, you would start to get paid because of a loss in revenue this year. That's how this deductible works at 85%. If I bought the supplemental coverage option, the county policy at 86%, that adds about 3 to 4 cents more to this. But I've been talking to some groups that what if we plant 95, 96 million acres of corn this year? Is there a chance we could take corn to 3.25, 3.15, 3.10 this fall? I wouldn't rule it out right now. And based on the monthly charts, if you look back over the last 10 years, we've had some years where we've done that. We've taken corn prices down close to the $3 level. So with big acres this year, if demand doesn't improve, certainly there's a chance. So today, my point is that today, the RSI is at a point, I don't want to be a seller of corn right now. Know that at least you do have some protection below the market in the form of this policy. And by the way, for those that bought margin protection insurance last fall, that price was set at $403 back in September. Well, if you bought that at 95%, the maximum coverage, that comes in at about $3.83. And so again, if my county ended up with average margin, if the yield ended up the same, if the input prices didn't go up and down, then price would only have to be below 383 to start to trigger a loss margin protection. And you can see right now we're 380.5, so we're kind of in the money as we speak today. So I don't want to be a panic seller today. I want to let my policy do what it's supposed to do, and that's provide some downside price support at this point. And if we get a rally, and utilize the call option in the policy to make some sales, knowing that I'm protected if the price goes up and I lose the bushels because I've got that built-in call option as well. The cotton market, you could argue cotton's even closer than corn right now because in the southern states, we started at a 70-cent RP price, but 80%, if I bought an 80% policy, that's 56 cents. And so price today was only 62. We don't have to go down that much farther for an 80% policy starts to kick in if we have an average yield. And if I bought the supplemental coverage option at 86%, now you're only looking at a couple cent drop before you start to trigger a potential indemnity. And so, again, keep that in mind. This is part of the reason why I don't want to be a panic seller today. I know that I've got my policy and I've got my protection. It's also a reason that if you haven't bought your insurance yet, if you still have a few more days, maybe you look at buying up a level. Maybe you look at getting this price put option as high as you can since the government's going to pick up roughly half the cost of doing that. So just some food for thought here as we work our way into the sales closing period here in about 5 days. The farm program, just a quick update. I mentioned some of these prices earlier when we were going through the numbers, but the market year average price estimates are in this gold box right here. USDA did change the corn, the soybean, and the sorghum numbers. They lowered all three a nickel in this month's report. The seed cotton number has not come out yet for March, and the peanut number has not been posted yet for March. So those are still from February. I would imagine the cotton number is going to come down. The peanut number will probably come down as well, since soybeans and cottonseed are probably going to come down. But the point here is that if these prices at the end of the year are below the PLC prices in blue, the PLC would be triggering a payment. And as it sits today, the ones that I've highlighted in gold from wheat down through peanuts all would be triggering PLC payments. And I would favor the PLC program for all of those crops, knowing that at the end of the year, I'd be looking at somewhat of a substantial payment. Now, corn and beans for 19 crop year do not look like they're going to trigger PLC payments. Both of these prices are above the reference price. So, ARC might come into play for some folks. ARC uses this benchmark price, the left hand red box, 370 corn, 963 beans. Take that benchmark price times your county's 5-year Olympic average yield from 13 to 17, and then take that times 86% to determine your benchmark trigger for the ARC program. At the end of the year, you take final county yield times this market year average price in the gold box. And if that revenue is below the trigger, you get paid the difference on 85% of your base acres. What makes corn unlikely to pay for most folks is we started with a benchmark price at 370, but this year's price is at 380. So in other words, we're going to have to see a fairly substantial bushel loss. And I've done some math, anywhere from really 25 to 30 bushel an acre in your county. We're going to have county yields below the 5-year Olympic average in order to start to trigger an ARC payment. So in all likelihood, I don't think ARC or PLC is going to pay for corn in most areas of the country for 2019. There may be a few, but where the yields were really down this year. But for the most part, I don't think it's likely to happen. Now, for 2020, I still like the PLC program because if I think there's a chance corn price could get cheap, then this floor at 370 looks pretty good for me versus a revenue floor using 370. And what I would plan to do on corn is use PLC to have a price floor, buy my revenue insurance using this year was 388 that was said in the northern states. So I buy revenue insurance to protect my bushels on my farm. And then hopefully I'm going to get some corn sold here up around this $4 level on December futures. And if I get all of those things done, I'll feel pretty good about the corn program. Soybeans. One thing that makes ARC look good on beans is that we started out with a 963 benchmark price compared to 870 this year. 93-cent drop, which means that our county yields only have to drop a couple of bushel an acre or so in order to start triggering an ARC payment. Versus PLC, we know will not be because we're 30 cents above the reference price. So I'm favoring the ARC program in a lot of areas of the country this year. There will be a lot more areas that trigger ARC payments on beans than they do on corn. That said, there may be some areas that don't trigger ARC payments as well. So keep in mind this is a 2-year deal. So, historically beans don't pay a lot anyway, but if you think you're close to getting an ARC payment this year, I'd probably go with the ARC County program. Otherwise, I think it's a coin toss, and neither program may pay for the next couple of years unless something happens to where we see a big washout in bean price. Just some of the particulars on the program. The deadline is March 16th, actually, so just next Monday. It's a 2-year election. This will be for the 19 and the 20 crop years. After this, each year you'll get to elect the program for 21, 22, and 23. It's a farm-by-farm, crop-by-crop decision, so I can mix it up between crops and by farms. Payments get made on base acres. Keep that in mind. You don't get paid on what you plant. You get paid on what your base was set up as. So 85% of those acres for the ARC County and the PLC programs. The program yields an FSA. It gets to be updated, and that has to be done by September 1st. And this will start in for PLC for the 2020 crop year and beyond. But it's a good opportunity to raise those numbers if you can. Last thing I'll mention, I talked about SCO earlier, the supplemental coverage option. This is available only if you elect the PLC program because it's very similar to ARC. Both SCO and ARC are county-based protection. They don't let you double dip there, but if you do elect the PLC program, like we're talking about with many crops, that would keep you eligible to purchase the SCO program above your policy. So a quick summary. Again, these points I made at the beginning, I'm going to try to get the right insurance coverage for my operation, use the right government program, use a variety of marketing tools this year. If I do all of those things, I think I can set myself up for a decent year in 2020. Just a quick commercial. I just want to mention the programs that we offer at NAU Country. I am offering this opening bell phone call every morning. It's a 2-minute phone blast. It comes out about 8:35. Let you know what's going on in the market at the open this morning and why. I send a market report out every afternoon with an update on the markets that night, what the market did, why it did what it did. This is where I will put in ideas and thoughts on the markets as far as maybe those put call strategies, things like that. But if you're interested, this is where you'll find that. It's an email letter that comes out each day. If you're interested in either of those, let your agent know, let me know, someone with NAU Country know. We can get you hooked up to be able to receive those. There's no cost to you. We're just trying to get information out to help you be successful. I also record a podcast about once a week or so called Kicking Up Dust. You get a chance to go to Podbean. You can search that. You can register to receive updates when that podcast comes out. We're going to do these afterMATH webinars every month, the day following the USDA crop report. So a lot of different ways to try to get information out to you. A couple of other things I want to mention. For those not familiar, the Field Insights program is something I'm really excited about. I think this is a really cool deal. It's available either on your desktop or on your phone. gives you weather information at your fingertip for your farms, shows you what moisture you've had, what your spray window looks like. You can set it up to get hail acknowledgments. So a lot of neat tools that can be used through this Field Insights program, and this is only available through NAU Country. If you've got a policy with NAU Country, you can get set up to be able to receive this. We also have some other add-on tools called the Base Price Modifier, the Price Modifier Plus. These are a way to get extra price protection in your policy. If you have a bushel loss, R-Power D allows you to get extra yield coverage and or extra months added to your policy for your base price. There's different, this can be, you can make this thing look any way you want it. So pick which months you want, how much extra protection you want. M-Power D is the same thing for margin protection. So we had R for the revenue and M for the margin. So we'll be talking about that later in the summer. But if any of these products are of interest to you, again, talk to your NAU Country agent. We can get you set up. Some important dates coming up. March 31 is a big one. It's when we get the Planning Intentions Report, and this will be USDA's first official estimate of acres for this year. The Ag Outlook Forum a couple of weeks ago was just a guess. These will be based on the 31st, based on surveys with producers. And we'll also get a grain stocks report that day and kind of show us what the winter feeding numbers look like, what the disappearance was throughout the winter months. April 9th, we'll get our next USDA WASDA report. Then the next morning, on the 10th, we'll have our next afterMATH webinar. So mark those dates on your calendar. Those will be big for the market and big for talking about markets. So with that, I thank everybody for joining me this month to the afterMATH webinar, and look forward to visiting with you again real soon. Thank you very much.